Andrew Holland, Chief Executive Officer, Investment Advisory with Ambit Capital. Andrew, morning. Thank you for joining us. Andrew, how hard I try,
morning.
I cannot sugarcoat the environment, and the outlook for banking stocks is just getting from bad to worse.
Yeah, it's difficult to get even more bearish than you actually, Nikon. So I think you summed it up very well. There's lots of headwinds there, and I think if you look at the airline sector, I think that was gives you an idea of the problems out there. The power sector is another area which is of huge concern, and you can now throw in retailing because without the kind of FDI limits being increased, and there's a lot of retailers out there who are suffering very badly with huge amounts of debt. So if you look across the board, India Inc. is not feeling very confident. They're going to sit on their cash if they have any, and the banks are going to have to take a big hit on their provisioning. So not very good at all. The one hope you have is obviously that interest rates will come down a lot quicker than maybe we're all expecting, but that would be obviously based on some kind of negative event happening in Europe or particularly China, which is of concern to us at the moment.
Andrew, morning. You're of the view that it's the markets that make the news and not the news that make markets, really. But give us an indication of what you're factoring in terms of your GDP growth, in terms of the inflation projection, and what that's likely to do to the overall Indian economy.
The Indian economy is doing okay. I mean, it's obviously slowing quite quickly in terms of the GDP growth. But I think 6-7% is in the environment that we're going to be facing in 2012. I think we'll be seen to be very robust. I think the problem is not really that the inflation won't come down. I think we're starting to see that now, and obviously the base effect will help going forward. I think the big problem now in India is not the inflation. It's more to do with the leaders of industry who are very, very downbeat at the moment. Really can't see a way out of their own problems and India's problems, and really that's that's kind of feeding through to whether they're going to invest in large-scale projects. To the fact that they're having to start to cut costs, and they'll do that quite aggressively now. So it feels a little bit like, as Nicholas was saying, a little bit like 2008 in terms of the sentiment at the moment. So it's not a great year ahead, or the start of the year ahead as we enter into January.
Andrew, the 3 Ds which have worked for the year 2011 are: number 1, dollar; second is defensive; and the third is dividend. Which, to your mind, are going to be some top or popular themes for the year 2012?
Yeah, I mean, I think those 3 will continue probably to work in the very short term. The things on my mind at the moment, obviously one is what's happening with Europe, and until the market gets what it wants. And what does the market want? The market wants the ECB to throw money into the system through quantitative easing, and they also want them to be a backstop for the banks. ECB is resisting that, and I think the market will test that resolve. So that's the negative news. China is the other area which concerns me. The property market there really crashing very, very significantly. Now all of that leads to the fact that there's going to be a big fall in markets sometime in the first quarter. Now, after that's happened, there's trillions of dollars of cash sitting on the sidelines, and I think that will come into play as soon as these events play out. Obviously, if the ECB do something which would amaze us, which would be to throw money into the market and be a backstop for the banks, that would have that money very quickly going into emerging markets as well as developed markets, and you could see the Indian market rise very quickly. So what I'm thinking is that a tough time into in the start of 2012, but if this money does hit the investment in terms of equities, then obviously we could see a very good rally in markets such as India.
Andrew, Ambit was absolutely bang on when it came to the bearish stance on the banking arena as a whole, especially the PSU banks, the likes of an SBI. But what's the call on the banking sector, which is seeing pronounced weakness right now? Do you see value emerging anytime soon?
Well, it depends on what you call value, because obviously I think we're still finding out where the hard areas are for the banks in terms of provisioning. So I think that's still to come. So I don't think you can look at valuations today and really say that that's the correct valuation. I've always said that interest rates will come down. Interest rate sensitive such as banks will be a play at some stage. But you stick to the HDFC banks, the banks which deliver year in, year out despite the even growth, slowing growth in India, and that's the bank I would stick with. If I'm going to play interest rate sensitives, then I'll play HDFC initially, and then start to look down as to the other banks, the PSU banks, as the economy recovers. But at the moment, I would steer away from PSU banks. I don't think the valuations are the real valuations.
Andrew, so what would you call as value stroke bargain stroke attractive stocks for the year 2012, irrespective of the title? Identify some money making ideas for our viewers.
I said I think it's going to be a tough start to the year. So for your viewers, I would say you can actually kind of keep away from the market. I think you should be looking at the interest rate sensitives. I think Bajaj Auto, HDFC. Keep to some of the defensives like Hindustan Unilever, ITC, Nestle. People still need to eat and drink and smoke, so the demand will not go away from those companies. But increasingly, as matters evolve in terms of Europe and China, then you will get some good opportunities in areas like the banking sector, infrastructure, in terms of capital goods companies, which still probably have more to fall yet. And those will be the time when I'll be looking to go aggressively into the market. But at the moment, I don't think you need to. You're playing a relative game. I think you're going to get relative performance by the stocks I've just talked about. I don't think you're going to see real absolute performance in the very short term.